Hi everyone, I am Shruti and welcome to another edition of G2 Financetech's weekly market update, your weekly walkthrough of key shifts in the world's leading financial markets. This week, we are calling it the calm before the next storm. Central banks are leaning dovish, trade headlines are still dominating, and while markets are showing signs of resilience, under the surface, volatility remains. Let us break it down region by region. United States, mixed signals and a glint of gold. We'll start in the US, where it was a shortened trading week, but no shortage of headlines. Tech stocks took a hit midweek following fresh US restrictions on chip exports to China. Names like Nvidia and AMD felt the weight, dragging broader sector lower. Meanwhile, Fed Chair Jerome Powell struck a cautious tone, noting that the impact of tariffs could be larger than initially anticipated. Translation: don't expect rate cuts just yet. On the housing front, builders remain wary. Confidence stayed subdued and new housing starts slid over 11% in March. DR Horton, one of the largest home builders, scaled back its outlook, citing affordability concerns. But it wasn't all gloomy. Retail sales swapped 1.4%, the best in over 2 years, driven in part by car buyers rushing to beat the next round of tariffs. A sign of consumer strength? Perhaps, or just savvy timing. In the bond market, treasuries caught a bid as investors reacted to Powell's cautious stance. Yields pulled back and risk off sentiment briefly returned. And yes, gold continued its steady climb with policy uncertainty and global tensions brewing. The yellow metal flirted with $3,250 an ounce, reminding us that in times of doubt, some things never go out of style. Europe, a dovish shift and renewed optimism. Now to Europe, where markets staged a comeback. The Stoxx Europe 600 rose nearly 4% over the week, buoyed by two major developments: a temporary pause in US tariff escalation and a rate cut from European Central Bank. The European Central Bank trimmed its key deposit rate to 2.25% and signaled it's not done yet. Officials dropped hawkish language from their statement and emphasized a meeting by meeting approach amid softer inflation and weaker growth. T. Rowe Price European economist Thomas Viladek expects rates could fall further, possibly to 1.5%, underscoring the European Central Bank's shift towards supporting growth in a turbulent global trade environment. In the UK, inflation surprised to the downside, easing to 2.6%. Services inflation also cooled more than expected. While the job market showed early signs of softening, wage growth remained solid. The Bank of England's balancing act continues, but the market is increasingly pricing rate cuts sooner than later. Japan, diplomatic hopes and data caution. Moving east to Japan, markets were in the green. The Nikkei climbed 2.4%, thanks in part to signals that US Japan trade talks are making progress. Japan is actively seeking tariff relief, especially for its auto sector, and investors seemed encouraged by signs of negotiation. The Bank of Japan is maintaining a cautious stance. Governor Ueda reiterated that rate hikes are possible, but given tariff related uncertainty, the central bank will stay flexible. Japanese exports grew 3.9% in March, below expectations and sharply lower than February. The impact of US tariffs and soft European and Chinese demand is becoming more apparent. Meanwhile, the yen strengthened, a sign of safe haven flows amid global trade unease. China, growth now, uncertainty ahead. Over in China, the mood was cautiously constructive. Stocks posted modest gains, helped by expectations of more stimulus. GDP growth for quarter 1 came in at 5.4%, ahead of expectations. But analysts warned that much of that growth came from front loading activity before tariffs took effect. With the full impact of US tariffs still ahead, Beijing is widely expected to roll out further stimulus. All eyes are now on the upcoming Politburo meeting, where officials are expected to lay out their response. China's strategy remains clear: offset external shocks with internal policy firepower. Fiscal support, infrastructure, and consumer focused measures are all on the table. So, what's the big picture? Markets may have found a temporary footing, but the cross currents are real. The Fed is now on hold. The European Central Bank is easing and China is gearing up for more stimulus. Trade policy remains a wild card and for now is driving both fear and opportunity. At G2 Finance Tech, we believe this is a time to stay grounded in fundamentals while remaining alert to global shifts. Volatility may persist, but with the right mix of discipline and insight, investors can stay one step ahead. That's it for this week's G2 Weekly Update. I'm Shruti and we'll be back next Sunday with more timely takes and smart analysis to keep you informed and prepared. Until then, stay sharp and stay ahead. Thank you.